starting an analytics company and now focus. Hello and welcome back to the Masters of Real Estate. This is Nick Shah, and today we're going to learn from Justin Hughes. Justin, how's it going, buddy?
Going well. Thanks for having me.
Likewise, very excited to have you. So, Justin, how do you introduce yourself these days?
Well, I'm a serial entrepreneur, and my career has been focused on bringing technology to the real estate finance sector. By and large, that's taken the form of building and developing real estate investment platform. And real estate guy, technology guy, finance guy, all wrapped up in one.
Building and developing real estate platforms to invest in real estate. That is a fascinating topic, and I'm sure a lot of our listeners get ads all the time or hear from others all the time about how they can invest in real estate online. So very excited to learn about all of that from somebody who has like you who has done it and built it, because it seems like you know a lot about that. So before we get into all that, Justin, people really want to understand how you're like. So, what spirit animal or bird best describes you, Justin?
I like that question. I don't know. Maybe I'd say owl. I like to take a 360 view of everything. I'm very thoughtful and knowledgeable. I claim to be, I guess, either loud or flashy. I think just thoughtful and methodical, and just always want to have a holistic perspective on the problems and challenges that I approach.
I love it. How a 360-degree view approach everything from a top-down holistic standpoint. That's also very management consulting ish, right? Which is just look at everything top down and look at all the factors impacting a certain problem you're focusing on.
Yeah, I think that, most situations, there's a lot of ways of looking at it, and there's a lot of nuance in how we can approach things. I'm not really a brute force kind of guy. I think that the right mindset and the right approach, you can swoop on opportunity that others might miss.
Absolutely. In terms of that, seems like you worked on a bunch of real estate startups and you're involved in real estate venture capital as well right now. If you had to summarize your entire professional life so far into a single metric, Justin, what do you say that would be?
Well, I'd say across all the projects that I've been a part of, we have successfully raised $500 million worth of investor capital and deployed that into a variety of real estate investment.
Raising and deploying $500 million through your work is quite a significant feat, Justin. But let's go all the way back to zero. Before you knew all these things and before you're so good at everything you're doing right now. When you look back at the past from the vantage point you're standing at right now, what's been your broad trajectory so far?
Well, I'd say that it all started kind of the desire to learn more. I've always been a tech guy ever since I was a kid. I was that stereotypical guy that my mom used to have me go fix people's computers when I was a child, and that was kind of always who I was, just the neighborhood IT guy. But I got interested in real estate in college, and just had an interest to learn as much as I could. So having conversations with people, reading books on the subject, and trying to learn what I could. And ultimately, I thought, okay, maybe my career can be in technology, and my savings can be invested into real estate as part of my retirement plan. Um, Along the way, I got to meet some really smart, great people, and I was able to actually merge those two interests into one. And then in 2012 was able to start my first venture-backed startup, which was realtymogul.com, which basically merged my interests in both technology and real estate. We built one of the world's largest real estate investment platforms, focusing on commercial real estate investing.
And after Realty Mogul, what did you end up doing?
Sure. Well, Realty Mogul grew into a profitable business, and I was also able to start another company. This one was focused on real estate data and analytics to help multifamily operators achieve greater return by analyzing patterns in the data in their portfolio to kind of optimize on profit and mitigate expenses and things like that. From there, I got connected a gentleman here in Los Angeles who was interested in tackling the real estate investment platform problem And again, just something that I've always been really interested in. And so started another company called ShareLand, which is another real estate investment platform, although a bit of a different approach. Instead of it being acquiring assets and fractionalizing the equity across investors, we have reimagined what is a perpetual futures contract and allow our users to speculate on neighborhoods and cities. And with this platform, what's really interesting, you can actually take a short position. So for institutional investors that have exposure to different um, submarkets across the country, you can actually take a short position as well. And so this is something that I find to be really powerful. So not only can you get long exposure at the neighborhood and city level, but you can also hedge your equity and take a short.
Incredible, Justin. Who like you were, really good at analytical stuff when you were a kid. This technology is basically just hyper analytical stuff, and grew from being a neighborhood tech support person to uh, getting obsessed with real estate in college, and then using your, the savings you had from your tech jobs to invest in real estate, to starting a real estate investing company, to starting a real estate analytics company, and now focusing back on real estate investing again. So it's quite a journey. But seems like I had a chance to look at your background, and seems like you were studying cognitive science in college. So how did studying cognitive science um, overlap with picking up and reading a bunch of real estate books?
Yeah, I guess, seemingly completely unrelated, and they really are. No, cognitive science caught my attention in college. Just, I've always been fascinated by the human mind and human behavior, and so this gave me the opportunity to explore that arena. Not only from a philosophical perspective, but one of the things that really attracted me to it was the computer science angle as well. Maybe it's not obvious, but cognitive science is a multidisciplinary field. It crosses the obvious with philosophy. What is the mind? The neuroscience, the physical foundation of the mind, behavioral psychology, linguistics, which is almost the software language of the mind, and then computer science, where we attempt to model out how a mind might work. If the mind is the software operating on the hardware of our brain, then who's to say we can't model out a mind on a physical computer? And in fact, when I was in college, this field of computational modeling was the precursor for what is known as machine learning. And while at Berkeley, I got to see the birth and evolution of machine learning firsthand. And for me, as a technologist, I just love this for a variety of reasons. One, the technical applications of machine learning I think are fascinating, and we can see the impact that that's had on the world of technology as a whole. But also just understanding the human mind and our behaviors as people, and how we might develop technology, the user interface, user experiences that are going to better facilitate what we're trying to accomplish with the technology in our lives. And so for me, that was the approach. It was, how do we build better technology to better serve the end user? Because at the time, a lot of technology, it's, not to knock it too much, but sometimes it's engineers developing software for engineers without fully grasping the end user. And so that was kind of that part of my life. But the real estate kind of was unrelated. It just, I just had a long view of life. What did I want my retirement to look like? How would I get there? I'm in college. I'm about to start a career. How do I prepare myself for the future? And I don't know, just real estate as an asset class. I think, maybe it goes without saying, but I'll just say what probably most of your listeners and viewers already know. I mean, the appreciation, the depreciation, the cash flow, the principal repayment. All the different things that we all know and love about real estate as an asset class, ultimately leading to just the passive income. And so, my intellectual curiosity for technology and my desire to have that be my career. And I guess because it was it came in to such an early age for me because my dad was in technology on the business and sales side, and so I had exposure into that. And but then, it was like, okay, well, I'm already on this technical track. I'm now learning about real estate. I'm going to stick with technology, and then hopefully I can pick up real estate as I go along. And I was lucky enough. that was the case. I was able to kind of marry the two passions and kind of enjoy both.
Yes, it seems like after college you picked up a tech job, and from what you said, you invested most of your savings in real estate. 2012 was a weird year because it was kind of the bottom of the housing market in residential real estate. So, what inflection points led you to you launching your first company at the intersection of real estate and tech in that year?
Yeah, yeah. Actually, it's a great question. Obama had recently signed the Jobs Act, and the Jobs Act, one of the main components there was that it was set to, take another pass at the regulatory framework that we are all operating with the intent to incentivize uh, allow for more fundraising for different endeavors, whether it's startups or otherwise. And in many ways, the real estate syndication is a kind of micro startup. Generally, there's a single purpose vehicle, there's a managing team, you're raising money from limited partners, you're acquiring and managing an asset, and it's going to have a full life cycle. A startup isn't all that much different. And so ultimately, at the end of the day, you have this fundraising. And the regulatory framework is going to tell you what you can and can't do with those fundraising activities. And so our goal was to leverage the upcoming changes with the Jobs Act and create a platform that would allow more access to what I think is one of the best asset classes imaginable, and give that access to people that would have otherwise not have had access. And so that was the mission with Realty Mogul, which was let's build a platform and democratize real estate. Let's allow more people to get access with less barriers to entry. Whether those barriers to entry are access to good deal flow, the knowledge necessary to properly underwrite a transaction, or just the cash required. If you're going to buy an apartment building, I mean, you need a lot of cash. Even if you're going to be an LP, you need a lot of cash. The minimum buy-in is still pretty high. And so for us, bringing those barriers to entry as far down as we can by taking advantage of the change with the Jobs Act is what we did.
Fascinating. Yeah, that's a really good point. Obama had just signed the Jobs Act around that time, and it really democratized access to funds for retail investors, which is another way of saying it let people invest small checks into the fund instead of being a really large investment. And it seems like Realty Mogul, the company you started a co-founders, was one of the first of its kind, which probably is another way of saying you made a lot of mistakes for the first time that everybody in the industry realized later. So, what were some of the key learnings and moments from that phase of your life?
Well, yeah, I mean, it's, when you're a pioneer on the frontier trying to do stuff that other people haven't really done before, at least not in the way that we were trying to do it. Yeah, I think in many ways, you're just trying a lot of things and seeing what works. Uh, there's how do we raise money for an asset, but also give access to as many people? And when we're talking about securities regulation, there is the distinction between accredited and non-accredited investors, which is basically a determination around income and net worth, where if an investor has a certain income and certain net worth level, they're allowed into, or rather, as an issuer, you can you can, if you're limiting yourself to investors that have the disposable income, then you're not subject to the same level of scrutiny if you were letting in, the average person off the street. Again, just a mechanism, put in place by the regulator to potentially protect people from bad actors, right? If you don't have a ton of money and you get scammed out of a lot of it, then you're in a really bad position. So I can understand where the regulators are coming from, these kinds of things. So at any rate, you know, that's just kind of having to navigate that. How much, because in order to allow more people in, then we have a higher regulatory overhead, but too much of a regulatory overhead, and then the cash flow on a deal is now being completely absorbed by paying legal fees. And so trying to find the right balance, that was always really the challenge. And so how do we appropriately apply the different tools in the toolbox with different assets and different deal structures to bring these different opportunities to different people? And so sometimes it's tough. you have to place some bets on different asset classes and different deal structures, and hopefully, and then do things appropriately, with the right filings, but then still have a good yield target for your investor, because of course, you have to meet the yield target of your investors, what they're hoping for to achieve, or else they're not going to invest. Um, but yeah, I'd say one of the first things that we really learned was focus. I think once once you start to see the different combinations of what works and what doesn't work, and then really kind of focusing on that, and because there's a big pipeline there, from working with deal sponsors and what's their deal flow look like, and how do we underwrite that, how do we present that to the platform, and what's their appetite for, and so how can we kind of connect those dots and really streamline that and facilitate that. But I mean, it's not I guess I wouldn't even really classify it as mistakes, and I don't want to come across as sounding arrogant, like we never made no mistakes, but it's really just exploring and trying new things and seeing what works and what doesn't. One of the things that I'm really excited about with the new company that I'm a part of, um, is that we're taking a completely different approach for this, uh, because it's like a futures contract where you're speculating on the housing prices, and so there's long side investors and short side investors. What we're able to do is give exposure to the housing markets, but without having the assets themselves. And so what that does is it shifts the regulatory framework that we will be looking to operate within, outside of the SEC security law side of things, and into more futures contract commodities, CFTC side. And so in the CFTC side, the distinction between accredited and non-accredited investors, that's a securities law distinction. And so the hope is that we'll be able to um, expand the market of investors that can utilize our product by pursuing that pathway. And then also without uh, individual assets. I mean, one of the biggest friction points is that you're asking your end user to come to the platform and look at a specific deal. And there's so many different dimensions to that deal. There's the asset itself. There's the deal team, the sponsor. What's their track record? What do they like? Then you're kind of underwriting the platform. Well, like, is the underwriting team for the platform good? Do I believe that they're going to be around to service my investment for the long haul? What happens if something goes wrong? Like, will there be a servicer in place so that I get my distributions and my tax documents moving forward? And so there's a lot of friction in place when assets are involved. And so not only from a regulatory perspective, but from a user experience perspective. And so I think these are, having tried a variety of different ways of approaching this problem, which ultimately, again, is just how do I empower as many people to get exposure to the best asset class on the planet as possible, and how do I make it easy? And if I can enable people 10 seconds to invest a penny and hold it for whatever amount of time they want, then that's as good as it gets, right? Like, and so it's always about reducing minimums, reducing transaction costs, allowing full liquidity so that your hold time can be whatever you want it to be, not being stuck into the full life cycle of a particular deal. That's my mission. And so that was one of the lessons that I learned. If there's a way that we could do it without using assets, then I think we can hit some scale that would empower people to get that exposure. And that's what we're doing with ShareLand. The simplest way of thinking about it is, um, we also use blockchain technology. Not that we're like a crypto company, because I think that there's some negative connotation. We just happen to use that as our backend foundation, because that enables us to create a really cool financial innovation where effectively we can tokenize the economic value of a square foot of real estate. So, for example, let's say there's a neighborhood where the average home out there is trading on average $100 a square foot. And this is how we think of single family residential homes, by dollar. And so we've built a platform where if that neighborhood is $100 a square foot, you can buy and sell tokens at $100 a token. And so if you want to make a 100 square foot investment, you can buy 100 square feet. You can buy a penny worth of real estate. You can hold it for a second. You can hold it for 10 years. You can go long. You can go short. And so it's a really exciting platform that allows people just unprecedented access to the asset class. in ways that you can't do otherwise. Meaning you can go short. I mean, I can't go borrow my neighbor's house, sell it for what it is on the market, and then later buy it back and then return it to him. In the same way you would take a short position with stock, right? I can borrow a share of Apple from my broker. I can sell it. I hope it goes down. I buy it back. I return it to my broker and I pocket the difference, a traditional short position in the stock market. You can't short real estate because I can't borrow someone's house and sell it, right? And so that's another problem that we've solved with ShareLand. So a lot of things I've learned over time, just kind of the different regulatory frameworks and the different environments, the user behaviors, what people want, and ultimately what different combinations and things that we can try to ultimately provide that value to the end user. And so this latest iteration of what I'm trying in my entrepreneurial journey has me most excited. And so anyway, if people want to learn more, you can go to share.land and come join us on our Discord server. Come say hi.
Oh, this is incredible. This is incredible. So let me break it down. So here's what I understand. So basically, seems like you've been focusing on trying to solve this problem since 12 years. Now,
Mhm.
that doesn't mean you haven't solved the problem. You converted Realty Mogul into a profitable company and then worked on analytics for a little bit, and you're coming back to solve the problem again. The problem seems to be a three-sided marketplace, right? People want to invest money in real estate. Developers want money to invest in real estate. Developers or operators, whatever you want to call them, they're basically legally general partners in their fund. And then there are regulators who want to make sure everything's kosher. Now, when you try to solve the problem before, you basically solved a lot of problems for investors who want to invest money in real estate. A lot of problems for regulators to make sure everything was kosher and above board, and then some problems for developers who are or general partners or operators, whatever you want to call them, to make sure they were getting money for real estate at the right time as well, right?
Yep.
And at the right volume as well. And you solved all that in 2012 with your company, Realty Mogul. It grew dramatically, it's profitable, it was growing. And then you left that and worked on real estate data and analytics to help your people who own a lot of real estate maximize the returns. And now you're coming back to solve this problem. And now this time you're looking at the three-sided marketplace. You're improving on everything. You're saying, okay, first of all, how do I make it into fewer nodes in the marketplace? How do I remove this problem of the developer or the operator, which you're doing by essentially tokenizing real estate. On the regulatory side, seems like you're innovating, saying, okay, SEC is a completely different set of regulations, but if I convert it into this type of a token, you will be regulated by CFTC,
Yes.
which is the commodity. Wait, let me make sure I say the right name. So, because the last thing we want to do is piss off a regulator.
Right. Commodity futures trading token.
Commodity Futures Trading Commission, which is separate from the Securities Exchange Commission. And then even for the investor, they want to invest as little as possible whenever they like, and they want to exit their investor whenever they like, which is the opposite of real estate. Because real estate is the definition of buy and hold. So you're also solving those problems.
Yeah.
And you're doing that all through tokenizing real estate. Is that the right summary of your last 12 years, essentially?
Yeah. That's pretty much it.
Wow, this is amazing. So you're kind of the bleeding edge of investing in real estate. So now help us understand again let's say if a neighborhood is trading at $100 per square feet, and I believe that the neighborhood is heavily undersupplied and demand for the neighborhood will continue to increase over time. And I want to take a long position in that neighborhood, saying yes, in the future it will trade at 120, 150, 135 square feet, and I want to exit and enter this investment at any time with a minimum of as low as 10 cents, which is very aggressive because even the regulatory framework of accepting 10 cents as more costs more to accept
It's the same difference. 10 cents to $1 million. It doesn't matter.
cents as that will, and now you're enabling all that. So, you know, how will this work from a operation standpoint? Can you educate our listeners on that?
Yeah, so actually, it's built on a technical innovation in the decentralized finance space. So for folks that follow the blockchain space, there's a lot is going on there. I'd say we can set aside some of the kind of frenzy, volatile trading behavior that we see in some of the crypto markets. But I think underneath it all, there's still some really interesting novel technology, right? I mean, and in many ways, blockchain is just a backend data storage methodology, the same as a SQL server is, in a certain way. And um, so with each generation of technology that we have at our disposal, more interesting things can be done. And I'd say that this technological innovation has allowed us to create a financial innovation because what we're doing with this tokenization is not necessarily something that you could do in a traditional technical stack. It would be wildly complicated to track and manage. And so I'll describe how it works. Think of it as like a vending machine, and there's basically a little dollar slot on one side, and then there's a token slot on the other side, right? And so I can put in a dollar to get it out a token, or I can put in a token to get out a dollar. And so effectively, I'm just swapping almost like a currency exchange between one and the other. And that machine, if anybody's interested to learn more about this kind of methodology, look up what are called automated market makers. And this automated market maker innovation, which came out of the DeFi space in the last handful of years, I'd say maybe 2017, 2018 at the earliest, is really what is the core underpinning of what we're doing with ShareLand. And so um, effectively, the way it works is we have a vending machine for each neighborhood and city that we support on the platform. And you can enter a long position by putting in a dollar and getting out a token. Of course, whatever the dollar per square foot average is, and for that neighborhood or city. And then if you want to sell it, you put in that token and you get your cash back out. Um,
Mm.
and the tokens inside the machine are all created through what are called collateralized debt. And so somebody effectively puts up collateral and is able to mint a token. That's where the tokens come from inside them. And so I could uh, I could get really nerdy really quickly with a lot of math, but it might be a little too deep for a podcast. I'll say that if anybody ever wants to chop it up with me on the finer points on how this works, I'm easy to find online. Come and hunt me down. You can get on my calendar pretty easily. Otherwise, just come into the Discord server and chat with us, or come to the website and see how it works. We even have a testnet live, so testnet.share.land. It's not using real money. We just give you fake money to play around with, so you can see it for yourself. But yeah, so it's the technical innovation of the automated market maker in the blockchain world that has allowed us to build this financial innovation, which is a token where the token price is pegged to the real world asset price. So it'll deviate a little bit. So if we're in a market condition that's rather bullish, there's more longs than shorts. The token price is going to trade at a premium to the real world asset price. And if there's more shorts than longs, it's going to trade at a discount to the token price. But there's always a pull towards the center line. So whenever it deviates, there's so for example, if there's uh, too many tokens, and so the token is trading at a discount to the real world asset price, there's financial incentives baked in to basically incentivize the community to reduce the token supply to bring the token back in alignment to the real world asset price. I'll give an example. So for example, because each token is previously minted, if it's ever trading at a discount, somebody has an in the money short, and all they need to do in order to capture their gain, they need to burn a token. So that means as soon as somebody captures their gain, they are effectively repegging the token. And so there's a variety of different examples of how this works, but think of it like there's a rubber band, and the further away, the stronger it pulls back. Now, that doesn't mean it's always going to be perfectly one to one. However, if you look at the charts on the platform, you'll see the real world asset price has a certain price chart shape, and then the market price of the token has a similar price chart shape. It's either just going to be shifted up or down depending on overall market sentiment, whether it's bullish or bearish. And ultimately, at the end of the day, if I enter the housing market by buying a house on a particular date and simultaneously buy tokens in that same market and then hold them for the same period of time and then exit both, it's the same percentage rate of return. The tokens basically just mirror what the real world price movements are. And so that's our goal is just to get people one-to-one correlated to the underlying market. And
That's incredible.
and by avoiding the assets, we make it easy. You don't need to worry about is there asbestos in the walls or if it's copper pipes, or you don't need to worry about the deal team. Is there fraud or, what's their track record? You just have to have an opinion on Beverly Hills. Do you think Beverly Hills is a good place to have exposure? Do you think, the current high interest rate environment is going to kill it? Do you want to go long? Do you want to go short? Simple as that.
Justin, this is incredible technology. You are allowing essentially anybody to take a position on the housing market, uh, get a settlement against it, and also get instant liquidity and invest as low as possible. That's game changing. How else? How does this benchmark to all the other innovation in this space?
Well, I mean, the way it benchmarks to other innovations in the space, I believe that there's a huge growth potential here. I mean, I think that we're trying to build basically the Robinhood for real estate, allowing people to speculate long and short, um, any amount, any duration for any city and neighborhood, and eventually globally. I think time will tell. We're pre-launch. We haven't launched our mainnet yet, so I don't have actual figures to back that up. But I think that we're taking a new and novel approach that nobody else has taken. This synthetic square foot, and I think that by shifting the regulatory framework, by eliminating the need for single asset underwriting and the reliance upon third party sponsors, we're going to be able to address a much larger market and scale things much larger than would otherwise be possible.
Absolutely agree, Justin. In terms of the technology, it's new. It's still going to be released. It's not fully live yet. The tests is live, and we'll add the link to the testnet server in the description. But what are once it's fully live? What are the risks of working with it?
Well, I mean, the risks are there for any investment. I mean, there's no there's no guarantee on return. You can lose money as easily as you can make money. I think, but make sure that people are responsible with the amounts that they're investing. Um, Also, I think real estate should be a portion of a well diversified portfolio. Nobody should put all their eggs in any one basket. Beyond that, the beauty of blockchain technology like this is that there's a lot of transparency and the there's not a huge overhead to maintain the market. There are many players in the real estate crowdfunding space that have gone under, and that's thrown a lot of doubt as to who's going to be servicing those investments. And because these were done in a traditional syndication methodology with single purpose vehicles, um, tax documentation and distributions that are all needing to be processed. And when the platform goes under, then who's doing that? Who's processing the distributions? Who's generating the tax documentation? Who is facilitating the servicing of this portfolio? And so, I think that's a risk that people need to pay attention to when it comes to investing online, making sure that it's with a platform that's going to be able to, follow through on the servicing of those investments.
Yeah. So, for example, when a platform takes a lot of money from retail investors and invests it towards a lot of projects, and the platform itself runs out of money, what happens then, Justin? What happens to the money that people invested in? What happened to, like you said, the distributions that they were supposed to receive?
Yeah, yeah. So this has happened a couple times, and so folks can Google it. I don't want to throw anybody under the bus, but luckily, in most cases, a lot of protections were put in place, and so it actually ends up not really meaning all that much to the end user, because when these are structured correctly, you've got single purpose entities that can be basically scammed, and so the manager of those entities, kind of the mantle of responsibility, just gets transferred to another entity who can effectively perform those functions for the end user, so that as the asset, which is being managed by a deal sponsor, goes through its entire life cycle, and they're sending distributions and K1s and things like that to the SPV that has the pooled investors from the platform. Somebody is there to kind of facilitate that until it eventually winds down. Um, and so my understanding from when that has happened, it's been done well and done properly in a way where things are delineated cleanly so that it's kind of been a well orchestrated wind down of these different things. And then things go on. I mean, I think the only real tragedy in the space is when the underlying asset itself doesn't perform, or the deal sponsor doesn't perform, and the investment goes poorly. And then there's loss of capital or underperformance of the investment opportunity for the end user.
Makes a lot of sense, Justin. So it seems like retail investors right now who might be listening to this, who have invested in real estate before or are considering investing a part of their savings in real estate, should think about a lot of diligence areas before they write a check or wire money to an online platform. Apart from knowing that the platform's going to be stable for a while and the property they're investing in has operators who are going to be very, who are going to have a very high degree of integrity in how they invest their money. What else should they be also thinking about when evaluating online platform to invest their money?
Yeah, I mean, I'd say that the ones definitely to keep in mind are underwrite the platform itself, right? In this day and age, there's a lot of scam. You see a lot of scams where people think that they're investing in a reputable platform, they wire their money away, never to be seen again. Please do your research and make sure that you're working with a reputable company. I will definitely plug Realty Mogul and say, that is a good, high quality team. Um, and beyond just the fact that they're not a fly-by-night shitty company that's gonna take your money and run, what is their deal flow like? What is the deal quality? Does that company have a good, strong, investment committee with an underwriting team that is not just putting up garbage deals up on their so think about that, from that perspective as well. Then the individual deal, if it's a two-sided marketplace where it's a deal sponsor bringing that investment opportunity to the platform, you gotta look at that team. What's their track record? What's their history? Um, are they gonna be able to deliver on the promises that they're making? Then you'll need to look at the asset itself. Is that the kind of asset that you wanna have in your personal investment portfolio? Then finally, look at the financing. Look at the cap stack on the deal. Some people think like a loan is a loan, but you wanna really look at the terms of that loan, and make sure that that's not something that could potentially implode the deal as and then last, the deal structure itself. Uh, if there's any capital call provisions, what happens if there is a need for capital down the road? Is there, look at the pro forma, what could go wrong? Will the project be well capitalized to see it all the way through to the promised IRR that you're hoping for at the end? So it can be complicated. It can be complicated on traditional online real estate equity investment platforms because of all that. And again, this is one of the educations that I had that led me to how we structured ShareLand, which is to say you just have to have an opinion on the direction of your neighborhood or city and bet on the upside or the downside.
That's incredible. So, if a family office called you, Justin, and said, "Hey, we have had a lot of liquidity, and now we want to invest $100 billion, but just in real estate," how would you advise them?
Sure, sure. So I'm going to give the most like tech guy, real estate guy answer imaginable. Uh, Lately, I've been looking at how do invest in semiconductors via real estate, and there's a lot of coming live here in the U.S. Intel and other chip makers, and I think value-add workforce housing in some of these markets where these plants are coming online uh, make a really compelling argument, in my opinion. And so, there's a bunch of plants in Arizona. I think I was looking at the other day. Where was it? Somewhere in Missouri. Or no, I'm sorry, near Columbus, Ohio. I think there's another plant that was going in there. Anyway, there's a lot of examples. And so anyway, generally, I am a big value add multifamily investor. I just think that, you can find mismanaged assets out there that need a little bit of TLC and love, where you can make a better home for your tenants, and 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 there's a reward for doing that. And then also, I like the semiconductor industry. I mean, again, just as a blockchain guy, you see how a lot of these companies make a lot of money because of crypto mining, but now with large language models and the AI field blowing up, and the chip demands for that sector. So I just see that there's going to be huge growth in kind of these technical sectors, and then the workforce housing to support that sector. And so it kind of, again, marries my two favorite things, and that would be how I would deploy that capital.
I love it, Justin. And for people who have never heard the terms value add and workforce, can you explain to them, what they mean?
Yeah. Well, I mean, basically, it's just if you think of apartments as a product, and sometimes there are some assets out there where the product is below market. It just has a lot of deferred maintenance. It's just, I mean, slumlords exist. I hate to say it. That creates opportunity for people that are willing to roll up their sleeves and add value. Basically, uh, put capital investments into an asset to revitalize it and make it a better place to live. And I think that those opportunities, always pencil out really well. Where you can take advantage of people that just haven't kept up the maintenance or put in investments into the future of a particular asset.
Absolutely, Justin. So seems like your thesis is, hey, semiconductor industry is going to survive for a very long time. Chip demand is going to exist for a very long time because of just the advancement in technology. They will need a lot of workforce to work near the plants, and a lot of homes near those plants might not be in a pristine condition, and therefore their rents might also be, below market rate. So buy those, make improvements. For example, renovate the kitchen, improve the appliances, and then rent it at market rate to the workforce that works in these plants will probably live there for a very long time. And that's basically your core investment philosophy of value add workforce housing for semiconductor.
Yeah. That's the bet I'm making.
Absolutely, I love it. And what's your personal real estate portfolio like these days? Just
Oh man. Well, I go along as an LP in certain deals. Because again, as a busy entrepreneur, I don't have time for personal active management. I do have an apartment building. I was operating an Airbnb, which was a lot of fun. But again, that takes a bit of active management as well. Um, so yeah, no, I'm again just like I like apartment buildings, no matter how you slice it. And then there was a student housing deal that I was in that actually performed very well. So if people have ever had interest in, it's like multifamily, but a little different than on the ball. So
it seems like you've dabbled in a lot of sub asset classes, from hospitality and Airbnb operations to residential and apartment, as well as student housing, which is a very niche residential investment that usually, turns around every year or every few years with tons of tenants. But then you also have to workflow. I mean, you also have to have amenities that are suited for students. And so it seems like you've dabbled in a bunch and you kind of know a little bit about a lot of things.
yeah, I guess it's just, I mean, it's funny. I a lot of my personal investing is more done just out of personal curiosity. Like I want to just try everything once and see what it's like. I mean, I even went along in a mobile home park fund deal at one point in time. I did a hard money loan for a fix and flip. I I think the only thing I haven't done is triple net lease investing. Um, and which I hear good things. But so I've dabbled a little bit of in a little bit of everything. Again, it just more to feed my curiosity than any other goal.
It's true. But the yields on triple nets these days are even lower than the 30-year treasury, especially with an anchor tenant. So, yeah, the market seems to be, caught, like there seems to be a lot of demand for triple net, and the market seems to have priced that in.
Yeah, I've been keeping my eye on it, but no, just never gotten around to pulling the trigger myself.
So, I'd love to learn more about ShareLand, which seems to be your biggest investment right now in terms of your time, which is your most valuable commodity. So, what's the story behind naming this entity ShareLand?
Well, kind of funny. So it's actually we came out of the Share Ventures venture studio. So this isn't your typical, co-founded out of a garage, startup story. Share Ventures is a venture studio here in Los Angeles. and we've got a great team that basically explores different problems, and we come up with a thesis around those different problems and develop a product and seek to reach product market fit, raise outside capital, and spin the companies off as their standalone business. And ShareLand is one of those ventures within the venture studio umbrella, and I'm the venture lead that's been working closely with the CEO of the venture studio to bring the product to market.
And what's your number one aspiration for ShareLand over the next 12 months?
Well, over the next 12 months, within the well within those 12 months, I'm going to bring. I would like to launch the platform. We're going to do. We're going to start with an international launch first, and while we were, basically, there's a we have to. The regulatory pathways are just different by jurisdiction, and we will launch domestically here in the U.S., but there's a process there with the CFTC, and so basically just going through those regulatory hurdles and launching in each jurisdiction as we get that done. And then there's a host of different feature set upgrades that I'd like to include as well. Additional, the ability to trade on margin, options trading as well. Again, these have technical requirements, regulatory requirements, as well as capital requirements to roll these out. But I would say typical milestones for any fintech platform.
Absolutely. And now, if you think about a very long term, Justin, you've been in, helping helping empower people to access the best asset class on the planet, which is real estate. Uh, Looking forward for the next 5 to 50 years, what's your ultimate vision for real estate investing?
Well, I would love to have ShareLand be the Robin Hood of real estate, and that's our goal, right? I always people have probably heard me say this all the time, but uh, I want my dad to be able to take a short position his neighborhood where he has his house, right, and have some downside protection for the majority of his personal network, right? Like if he's able to interact with my product, it's easy enough for him to accomplish that feat, which it was otherwise impossible, then I will consider it a vast victory for my plans and what I want to accomplish for the industry. And then just beyond that, allow anybody. You're driving down the street and you see the pawn shop being replaced with a Whole Foods, and you want to speculate on that insider information, or you are driving through a neighborhood and you're like, I cannot believe houses are $2,000 a square feet here. That doesn't make sense to me. And you want to take a short position, allowing anybody anywhere at any time with any amount of money to speculate on any side of where the prices are headed. And so empowering people to just have the ability to expand their diversity.
Love it, Justin. Would love to ask you a couple of rapid fire questions. First quiz, what's the biggest mistake you see your peers making?
Biggest mistake I see my peers making. Um, well, let's see. I guess I'll say I've always been a focus guy. The thing is everything is so much about execution, and ideas are easy, right? There's so many ideas, and to chase down every last idea, to do every little thing that you could possibly do is to say that I mean, look, I can do 100 things poorly, or I can do one thing really, really well, right? And so I think it's common in the startup space, but at the same time, you have to weigh that against, exploring other opportunities. And so there's a balancing act. It's tough. And so I think finding the right balance of exploring opportunity, but remaining focused to maximize the potential for your execution.
Absolutely agreed. Stay focused on the outcome, but nebulous on the details that will help you reach the outcome. And in the end, execution is everything. If your loved ones agree to be mentored by you, Justin, what is the most important skill you would teach?
Um, I would say patience is always like soft skills, I guess. It's funny. We always talk about the hard skills, like, just having the knowledge about this, that, and the other. But I think the soft skills of of patience and resilience. The mindset. I think I would want to help people be the best version of themselves, not necessarily teach them, whatever knowledge, because I think uh, the rest flows easily when you've got the right mindset. Or at least I can speak for myself that there's definitely been times in my life where my mindset wasn't the best it could be, and then there's times when my mindset is really strong, and my success and what I'm able to accomplish in my day to day, this versus that is completely different.
Absolutely. That was Justin Hughes, an owl who is hyper focused on empowering people to access the best asset class on the planet. Right now, he's building ShareLand, which he wants to build into the Robin Hood of real estate. If you want to check it out, go to testnet.share.land or check out their website share.land, or find a way to reach Justin and his team on their Discord, and we'll add a link in the description. If you ever want to talk about real estate anytime, shoot me a note on Nick at Home LLC.